Welcome to part 3 of accounting changes and error corrections. We covered the theory. Let's do one final review. Let's review our 4 categories. The first one is the principal. What do we do if there's a principal change? When I say principal change, the example could be like a change from LIFO to FIFO. If there's a principal change, we do retrospective treatment. We basically go to previous year and we adjust retained earnings, but we do not have any effect on current year income statement. Number 2 is entity changes. The most common example is the consolidation changes. Maybe previously they were a subsidiary of an entity, now they are not, or vice versa. If we see an entity change, we do retrospective treatment. The same way we adjust retained earnings. Your income statement, there is no effect. When it comes to estimate changes, when it's an estimate change, the most common is the depreciation and useful life change. What do? We do prospective approach. What I mean by that, we do not go and check the previous periods because previous periods were not incorrect. We did the estimate based on the information we had. Now we have new information. Therefore, there is no retained earning adjustments, but because the estimate changed now, it affects our current year income statement. When it comes to error, this one was just wrong. So what do we do if there is an error? We restate it. Those are too dark again. I'll go lighter green. We restate it. We basically go back to previous period where there was a mistake. We restate those financial statements. Even in the end, they self-corrected themselves. There's a retained earning adjustment, yes, because we restate the previous years. Does it affect the current year income statement? It depends on the error we corrected. If it was self-correcting, it does not affect current year income statements. Here you can see another table that differentiates all 4 changes. I'm not going to repeat the treatment portion or if there is a retained earning adjustment, but I want to go over the key traps that AICPA would like to ask on the exam. So those are the ones you should watch out. So the first one, if there's a principal, the entity cannot say previously I was using LIFO, now I want to use FIFO. They need to justify it and indicate their justification. You might encounter questions. Maybe it does not talk about justification. It is not a principal. Second one is entity. This is rare on the exam. Consolidation is the most common example. For the estimates, it is going to be the depreciation method. This is the most common trick they like to use because students see the depreciation method, they think it's a principal. Depreciation is an estimate because we estimate its useful life. That's how you can remember. And when it comes to error, we do the restatement. The most common example is the non-GAAP. They like to ask questions like, an entity changed from cash basis to accrual basis. Students can think it's a principal, but because cash basis is not a GAAP compliant, it is going to be an error. And here are the top 5 exam traps. Number 1, the most common is depreciation. If you see depreciation, it is an estimate, not a principal. If you see something, they make changes from non-GAAP to GAAP, it is an error, not a principal change. You can see things like it's impractical, or they cannot determine the effects. Switch to prospective. Disclosure is always required, no exceptions. And always we calculate the net of tax for the RE adjustments. And don't forget to multiply 1 minus the tax rate. So for example, it's like $40,000. That was the change we calculate, and we want to calculate the effect on retained earnings. If the tax rate is 30%, we do not multiply it by 30%, we multiply by 1 minus the tax rate. Here is the example of one of the traps. The company was using cash basis, now they are switching to accrual basis. It's an accounting principle change, so retrospective, but no, cash basis is an error because it is not a gap compliant, hence it is going to be a restatement. You cannot change from wrong to right, so it is going to be an error change, and we need restatement. On January 1, 2006, Brooks Corporation, this is 2006, is the change made. They changed their inventory method from weighted average to FIFO. They are both GAT compliant, so what do we think here? This was a principal change. Not yet, because we need to make sure they can justify it. When you see that, that's what you can think of or start to think of. The change was made both financial statement and income tax reporting purposes. They can justify the change. The following data is available. It shows like their weighted average inventory and the FIFO inventory. You can see their inventory value is higher now, which affects their cost of goods sold. Their tax rate is 25%, and it is asking the cumulative effect adjustment beginning retained earnings January 2006. So we have couple options here. I believe the option D cannot be seen. Let's ignore it for now. If you remember the formula, or well, let's talk about the trap first, one of the traps they are putting you. So a lot of students, when they see questions like that, they need to take the difference between the two methods, but they also get the sum of those. This is incorrect because inventory is cumulative, so we only get the inventory of the last year here. So previous it was 290, now it's 325, so the difference is 35,000, right? 35,000, we have difference here. If you remember the formula, we also need to calculate the tax effect on the retained earnings. It was 35,000 times 1 minus the tax rate, 25%, which is 35,000 times 0.75. It is going to be 24.375. So in this question, there are two tricks. One is the inventory cumulative. The second is calculating the tax rate. If you do not calculate the tax rate, you would see this option, but it is incorrect. We need to adjust retained earnings based on the tax rate. That is option B. Here we have the solution again. Hopefully it makes better sense. So here let's go over very briefly again. What did we do? We calculated their differences because like they made a principal change. The difference is $35,000 after tax adjustments. This change increases retained earnings because the method changes they made affected their cost of goods sold. Here is a watch out for the common mistake. Do not use the pre-tax amount. That would give you answer C. If you do the both of the years, you will get answer A. Another practice question, which requires a prospective application. Remember the prospective application for the future, so which is for the estimates. The answer, let's go to options. Change in depreciation method from straight line to double decline balance. I can almost guarantee you that you are going to see a question like that on the exam. Depreciation changes are estimates, so it is prospective. A change in estimated useful life on equipment, 8 years to 10 years to 8 years. This is estimate, that's one is clear. Correction and error in prior years. Depreciation, you can think it was an estimate, but no, there's a correction of error. If there's an error, you do not do prospective application, you do restatement. So the answer is 1 and 2 only. Okay, so for this topic, here is the final exam tips. So number one is the identify the category first. This is the most important. If you see a new information, think it's an estimate. If there's a mistake or error, you see it's an error, so you need to restatement. If there's a change, if it's more likely the principal change, but also if it's not gap to gap, it is error. So all those like little things, watch out them. Here is the keyword, new information, estimate, discovered error, error, depreciation methods. Formula, this is very important to memorize. I know the formula makes sense logically, but during the exam day, a lot of a lot of things can be mixed. So try to memorize the formula. We calculate the cumulative effects times 1 minus the tax rate. And this one is the disclosures. All the changes require disclosures. This one has no exception. Congratulations. I think you are ready. Now first try some multiple choice questions, then a couple simulations, and then move to the next topic. I would recommend you maybe a couple days later come back to this topic. You do not need the full study, but do maybe like a five minutes review. That is definitely going to help you. Thanks.